Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Hycroft Mining.
If you find our talks useful, please consider subscribe, like, and comment underneath.
So we have a really fascinating case on the desk today. It's pretty rare that we see the market get this heated of a company that, technically isn't making any money yet.
That is exactly where I wanted to start. I was looking at the financials this morning, and I'm scanning the income statement, and I just see zeros in the revenue column.
Right, a blank slate.
A total blank slate. And usually when I see zero revenue, my instinct is to, run for the hills.
Of course.
But then I flip over to the stock chart, and it is absolutely tearing it up. Hitting new highs, volume is spiking, everyone's buzzing about it. So why? Why is a pre-revenue mining company making this kind of noise? What am I missing?
You're not missing anything. You're just looking at the past instead of, the balance sheet. This is a classic turnaround story.
Yeah.
But with a huge twist. The buzz isn't about what they sold yesterday. It's all about a fundamental transformation in their financial health.
Okay.
To really get this move, we have to talk about the debt.
Let's unpack that then, because usually junior miners are just drowning in it. They borrow these massive amounts to dig holes, hoping they find something to pay it all back. It's the classic debt trap.
Precisely. And it's often a death spiral. High interest payments just eat up all the exploration capital, and eventually they capsize.
Yeah.
But Hycroft, they've pulled off something of a miracle here.
How so?
They are completely debt-free.
Completely. You're sure there are no convertible notes hiding somewhere in the footnotes?
Zero debt. They recently raised $235 million just to wipe the slate clean. But it gets better. They didn't just, pay off the credit card. They put a ton of money in the savings account. Right now, they are sitting on $175 million in unrestricted cash.
That's a massive war chest for a company that isn't even producing gold yet.
It is huge.
Yeah.
To put that in perspective, look at their burn rate.
Yeah.
That cash pile gives them a runway of over 3 years.
3 years?
Most junior miners are constantly diluting shareholders or taking on high-interest loans just to keep the lights on for another 6 months. Hycroft has a fortress balance sheet.
Right.
They don't need immediate cash. They can dictate the pace.
That changes the psychology of the trade completely. They're not desperate. They don't have bankers breathing down their necks.
Exactly. And if you want to geek out on the numbers for a second, just look at their liquidity ratios. This is where it gets really impressive.
I saw that. The current ratio is 19, and the quick ratio is 18.3.
It's almost unheard of. For the listeners who don't spend their days in accounting textbooks, the current ratio basically measures your ability to pay off short-term bills.
Right.
A ratio of 1 means you have just enough.
And 2 is considered safe.
Right. And they are at 19. They have $19 in liquid assets for every $1 of current liability. They're just swimming in liquidity.
So practically speaking, what does that financial safety net allow them to do?
It allows them to be aggressive where it really counts.
Yeah.
Exploration.
Okay.
So while their competitors are conserving cash, doing bare minimum work, Hycroft is moving from 1 drill rig to 4. They can afford to punch holes in the ground because they aren't worried about making payroll next month.
So they have the cash to find the gold. But let's talk about where they're looking. Because usually when a mining company finds a deposit, the next step is what I call the boring years. 5 to 10 years of permitting, pouring concrete, building roads. It takes forever.
And this is the second pillar of the whole thesis. This is what we call the infrastructure advantage. Hycroft isn't starting from scratch on some patch of dirt in the middle of nowhere.
What do you mean?
They're sitting on $1 billion of existing infrastructure.
$1 billion?
Yes, $1 billion with a B. This was a functioning mine before. They have the crushing facilities, the processing plants, the leach pads. It is all physically there right now in Nevada.
So it's like buying a house that's already fully furnished and renovated versus buying an empty plot of land and having to hire an architect.
That is a perfect analogy. And think about the replacement value. If you had to build that same facility today, with current inflation, it might cost $2 billion. They have it ready to go.
That's a massive moat.
A huge moat. If a competitor found a similar deposit next door today, they would be 10 years and $1 billion behind Hycroft. Hycroft has the permits. They have the gear. It put them years ahead of their peers.
Okay, so they have the money, they have the factory, so to speak. Now, what about the actual product? The geology? We're talking about Nevada, which is prime real estate for mining.
One of the best jurisdictions in the entire world. And the deposit itself is one of North America's largest. But what really got the market excited recently and what really drove that stock price surge was the new discovery data.
This is the wow factor I was reading about. They found some incredibly high-grade silverite.
They did. We're talking about a recent drill result. Get this. 18.2 meters at 1,987 grams per ton of silver.
Whoa. Okay, for our listeners who aren't geologists, break that down. Is that good?
Good is. That's
Yeah.
an understatement.
Yeah.
In this industry, we get excited about silver grades in the triple digits, maybe 1 or 200 grams. Anything over 500 is considered excellent.
And this was nearly 2,000.
Nearly 2,000 grams per ton, that is bonanza grade. It suggests there is a high-grade core to this deposit that nobody really appreciated before.
So it's not just a lot of low-quality dirt. There are actual veins of pure value down there.
Exactly. And it changes the economics completely. It's the difference between a chocolate chip cookie and a plain biscuit. The whole cookie's good, but those chocolate chips, those high-grade veins, that's where the real sweetness is.
And since they already have the facility, they can prioritize mining that material first.
Which boosts early cash flow significantly.
Okay, the fundamentals sound really strong. But you and I both know that in the junior mining world, you can have great rocks and still fail if you don't have the right backing.
100%.
So let's transition to follow the money. Because it's one thing for us to look at a spreadsheet and say, this looks good. It's another thing entirely when the titans of the industry start writing checks.
Always follow the insiders. And in the mining world, there is one name that moves markets more than almost anyone else. Eric Sprott.
The legend himself. I saw his name all over the recent filings.
And it wasn't just, a token purchase. This was cluster buying at a massive scale. Let's look at the timeline. On January 13th, he bought 4.67 million warrants.
Warrants.
That was a $28 million bet.
Can we stop there? Warrants. Why is buying warrants different than just buying shares? Why is that significant?
Great question. A warrant is basically a contract that gives you the right to buy stock at a set price in the future. So it's a leverage play. If you buy shares, you think the price is safe. If you buy warrants, you are betting the price is going to go significantly higher. It's a very aggressive, very bullish instrument.
So he puts $28 million into these aggressive wagers on a Monday.
And he wasn't done. The very next day, January 14th, he bought another 200,000 shares directly.
Okay.
That cost him about $6.64 million. And then there was another buy of over $3 million.
So he's doubling down. No, wait, he's tripling down.
When you see an insider, especially one as sophisticated as Sprott buying this aggressively, it just signals extreme conviction. He isn't dipping his toes in. He is loading the boat.
And it's not just him, right? I was looking at the institutional ownership. It's pretty locked up.
It is. Blue chip institutions now own over 80% of the company.
80%. That doesn't leave a whole lot for the retail traders, does it?
No, and it suggests that the big players have effectively cornered the supply. They're holding this for the long term. They're not flipping it for pennies.
They see the deep value.
Exactly. And when 80% of the stock is in strong hands, it means the float, the shares available for trading, is much smaller.
Which can lead to volatility.
Exactly. Low supply plus high demand equals explosive price moves, which brings us right to the chart.
Yeah, let's talk about the technicals, because the price action here has been wild.
Wild is the right word. We just saw a breakout where the stock hit new 52-week highs, tapping $45.09.
I was looking at the data from January 22nd, just the other day. It jumped nearly 15% in a single session.
And if you zoom out, the trend is it's undeniable. Year-to-date gains are over 300%, and the one-year return, it's up 1,775%.
Almost 1,800% in a year. That's a lottery ticket kind of return.
It is. And usually when a stock runs that hot, you worry about a pullback. But the volume is supporting the move. We're seeing heightened volume on these green days, which tells me this isn't just retail hype. Institutions are chasing the price up. Volume precedes price, as they say.
And I saw the moving averages are all pointing north.
Yep. Current trend analysis shows 4 distinct buy signals. And the sentiment score, which kind of aggregates news and analyst ratings, is sitting at a 9 out of 10. The market is overwhelmingly bullish.
Okay, so the past year has been incredible. The balance sheet is a fortress. Sprott is all in. But as investors, we can't buy yesterday's returns, right? We have to buy tomorrow's potential. So what moves the needle in the next 3 to 6 months? What's on the catalyst calendar?
That is the most important question. And we have a very specific timeline coming up. The first major milestone is right in front of us, Q1 2026.
All right, right now.
We're waiting for the preliminary economic assessment, or the PEA.
Why is that so critical?
Well, the PEA is the study that proves the math works. It takes all those drill results, the infrastructure costs, those silver grades we talked about, and it spits out a financial model. It tells the market, here is exactly how profitable this mine will be.
It de-risks the whole project.
Significantly. It turns hope into hard data.
And once that study is out, the focus shifts to mid-2026.
That is when they plan to restart the heap leach operation.
So, actual production, pouring gold.
Exactly. They're transitioning from developer back to producer. And the targets are ambitious, but I think achievable given the infrastructure. They're aiming for 50,000 ounces of gold and 1.5 million ounces of silver in 2026 alone.
And at what cost? Because if it costs $2,000 to dig up an ounce of gold, you're not making much money.
They are targeting an all-in sustaining cost, the AISC, of $1,200 per ounce of gold equivalent.
Oh, wow. With gold prices where they are today, that is a massive margin.
It's significant margin expansion.
Right.
We're talking over $1,000 of profit per ounce, potentially. And remember the macro context here. We're in an environment of rate cuts.
Right.
Historically, when rates go down, gold and silver rally. So Hycroft is ramping up production right into a perfect storm for precious metals.
So they're selling into a bull market with low costs. That is the dream scenario.
It is.
However, and you know I have to do this, we have to look at the other side of the coin. It can't all be sunshine and rainbows. What are the watch-out factors? What's the bear case?
It's crucial to be balanced. And there are two main risks we need to monitor. The first one is dilution risk.
Ah, the dreaded D word.
We saw shelf registration filed for roughly $163 million. That represents about 4.7 million shares.
So wait, even though they have all that cash, they filed paperwork to sell more stock. Why would they do that if they have a 3-year runway?
And that's the nuance. A shelf registration doesn't mean they will sell it immediately. It just means they can. It sits on the shelf.
Okay.
So the bears argue it's a sign they expect costs to blow out. The bulls would say it's strategic. Maybe they're eyeing an acquisition or a massive expansion we don't know about yet. But the fear is that if they dump those shares, it dilutes existing shareholders.
So it hangs over the stock like a bit of a cloud.
It does. The second risk or opportunity, depending on how you see it, is the short interest.
I saw that number ticking up.
It is rising fast. Short interest is up nearly 60% recently. It's sitting at about 6.36% of the float.
Which means there are people out there betting heavily that this stock is going to crash.
Yes. There are skeptics who think the valuation has run too far, too fast. They're betting on a correction.
But high short interest, that can also trigger something explosive, can't it?
The short squeeze. If Hycroft drops good news, say, that PEA comes out looking amazing, those shorts have to cover. They have to buy the stock back to exit their positions.
Right.
And that buying pressure, combined with the normal buying, can send the stock absolutely vertical.
So the bears might actually end up fueling the next leg up.
It's a very dangerous game for them, especially with someone like Sprott buying on the other side. But for a regular investor, it just means volatility. Don't expect a smooth line up to the right.
So buckle up.
Definitely buckle up.
All right, we've covered the financials, the assets, the insiders, the chart, the catalysts, and the risks. It's time for the verdict. Based on everything we've analyzed today, what's your final call on Hycroft Mining?
When I weigh everything, I have to give this a bullish score of 9 out of 10.
9 out of 10, that is high confidence.
The thesis is just so clean. You rarely find a junior miner that is debt-free with $175 million in cash. You add in the world-class asset in Nevada, the $1 billion in paid-for infrastructure, and the massive insider buying from Eric Sprott. It checks every single box.
And the path to production is clear.
Yeah, it's not some 5-year dream. It's a mid-2026 reality. If they execute on the heap leach restart, the re-rating of this company could be substantial. It's moving from a speculative play to a real cash-flowing producer.
Well, there you have it. A debt-free miner sitting on a gold mine, literally, with the heavyweights of the industry backing it. It's certainly one to watch very closely as we head through the first quarter.
Absolutely. The next 3 months will be defining.
Thank you all for joining Smart Wealth with Joshua. We hope this analysis gave you some clarity on the Hycroft story.
And remember, always do your own due diligence.
If you found this valuable, please subscribe and leave a comment below letting us know what stock we should analyze next. We read every single one.
Yep.
Until next time.